Alrighty, well, good afternoon and welcome everybody. Thank you for joining us today. My name is Andrew Doffney. I'm the Instruction and Outreach Librarian at the New Jersey State Library, and it is my pleasure to welcome our speaker for today, James Goodman, who is the Home Finance Consultant for the Credit Union of New Jersey. And he's going to be talking about all the home buying basics. If you're interested in buying a house, if you're a first-time home buyer, maybe it's been a while and you're have some questions or want to know maybe how the process works now, James has all the answers for you. But before we jump into the presentation, I just have a few housekeeping items to go over. We will be taking your questions today, so please feel free to submit them at any time using the Q&A or the chat feature in the Zoom dashboard. James has provided me with a copy of the presentation slides, so once we get underway, I will upload that to the chat and you can download it from there. If you have any issues downloading it, don't worry. This program is being recorded and a copy of the presentation slides will also be sent out in the follow-up email that I will send. There will be a survey available at the end of the webinar, so we ask if you have time, please complete the survey. We always love hearing your feedback. And if you want more information on home buying, the Credit Union New Jersey has a web address that's on the screen there that you can visit that gives you some more information and kind of reinforces everything that James is going to talk about today. So one last thing before we jump in is that this is just what your Zoom dashboard should be looking like if you're using a PC or a Mac. If you're using a mobile device, the dashboard may look a little bit different depending on the device you're using, but all the features will still be there. In the bottom left-hand corner, you will see your audio settings. So if you're going to be using an external listening device like a headset or earbuds, you can make sure that they're connected there. At any point during the presentation, if you have any problems, there is a raise hand button here in the middle. You can click on that and that'll alert me, and I will send you a message in Zoom and hopefully be able to solve any problems you are having. And lastly, if you have any questions or have any comments you would like to share, you can use the Q&A or the chat features. Either of them will get your information to us. So that is everything that I have for you. So it's my pleasure to turn it over to James now.
Thank you so much, Andrew. And let me switch screens here and let's see, share my screen with you. Let's see here. So can everyone, can you see this screen, Andrew?
Yes.
There we go. All right, got it. Okay. All right. Hi. Thanks again, everyone, for joining us. This is my name is James Goodman, and I work with the Credit Union of New Jersey. And we thank you for taking the time out during this lunch hour and spending it with us on a webinar. We'll make it quick, and I'll try to answer as many questions as I can and give you as much information as I can about buying a home. And this is a webinar that we do at the Credit Union. It's called Home Buying Time. It was just the basics when considering purchasing your home. Once again, my name is James Goodman. I am a licensed loan officer and work through mortgages for the Credit Union of New Jersey. And I'll also have my information, and we have a few other loan officers at the Credit Union as well that can help you, and we'll have their information for you too if you're interested after the webinar. Let's get started because we don't have a lot of time. And so when we're doing these live, one of the big questions we always have is, why should I buy a home? Well, there's a few good reasons to buy a home. I guess last year at this time we would say one of the best reasons because the interest rates were so low. The interest rates are not as low as they used to be. That are at least they were last year, but they're a little higher now. It's because they were trying to just stave off inflation. But it's still a good time to buy. It's still a great goal. Most people put down as home ownership as one of their big goals. So it's still a great time to buy. It's still some of the prices are actually a little bit better because it's more of a buyer's market at this point. I have a few bullet points on why the rewards of home ownership, which is sense of community. And that's just basically when you own a property, you purchase in a certain area, that area that you like, and you want to start a family there. And so when you actually, if it has a downtown section or it has stores that you like, and once you start walking into those stores more often, people know your name, your neighbors know your name. It's just that sense of community that you develop in the area that you decided to purchase your home. Yeah, some people put on their board as a goal, so that personal satisfaction thing. I want to be a homeowner. Some people are first generation homeowners. Their families never owned a home before, so one of their goals is to be a homeowner. And it's a great way to actually actually set up a budget, because once you own a property, let's say you go into a 30-year mortgage, you can set up that mortgage payment, and the payment doesn't change on a fixed product. Your taxes and information may go, which we'll go into, but your actual mortgage stays the same. So, like when you're renting, a landlord can come and take the rent payment up on you, and increase the rent on you. Once you own that property, you actually control that mortgage payment. You also control everything that goes into that house. So when you rent, if you wanted to paint the walls pink, you can't do that because the landlord won't let you do it. But when you actually own the property, you want to paint your walls pink, you want to put certain landscape in it, whatever you want to do. It's a property. You're financing it maybe through the credit union or through a bank, but you actually have all of the say so. You can do whatever you want because you are the homeowner. Tax savings. You want to speak with your accountant, but usually your first few years when you actually close on it on a mortgage, your deduction, you get a bigger return for being a homeowner from the interest that you've paid into it. If you paid any interest, you paid any points, so you get a bigger return. So speak with an accountant on that part, but it is a tax savings when you first purchase your home. Investment in the future. When you purchase a home, it's not just that you're buying a house because I need a place to live or I'm sick of renting, but it also is an investment for you because you just not you're purchasing a house at a certain price, certain down payment, but you also looking to increase what is called equity in that property. So, for example, if you buy a house for $100,000, put down 5%, you finance 95%, 95,000. As you continue to make the mortgage payments, that balance goes down, and the difference is called equity. And the more equity you build up, and what you want to do is at some point, the value of the house goes up, the loan balance goes down. Now it's an investment for you. You pay the house off. You can leave the house in your family's name, or you can turn around, you can sell a house and purchase another one. So it is an investment. It is a big investment. It's a big way to actually increase financial security within your household. And like I said, stability for you and your family. You keep the mortgage payment the same. You can control much more when you are a homeowner. And let's see, moving here. And so I'll go into what is called some of the key players, some of the people that you will work with when you're purchasing your first home. Now, when you first start looking for a house, usually you drive around and you see that for sale sign, and then you say, hey, you know what, I want to look at that house. And you just walk into it, and there's usually a sign on the front yard, and that's the seller's agent, and the seller is the person that owns that house. That's the seller. You're considered a buyer if you decide you want to buy at that point. So you have a buyer, you have a seller. A seller and a seller's realtor can actually offer you realtors can actually offer you their services and say, hey, you don't have a realtor, would you like to work with me? And that agent will be considered what's called a dual agent. But then you can we actually recommend that you go out, and once you decide you want to buy, and we'll show you how to get pre-qualified, then you want to hire a real estate agent, and it's called a buyer's agent. That you want to do that because you want that agent to be working specifically for you. Not that the seller's agent wouldn't, but you met them and they're on this listing. They're trying to sell a property. You just want to make sure that you have someone that's looking out for you. So that's why we recommend that you have a buyer's agent. Then so you have realtors, you have the buyer, you have the selling realtor, and then you have lenders. So you have a loan officer, you have processes that you will work with. Now lenders come in different forms. So you have the credit union, which is a mortgage lender, but also a bank, so a financial institution. You also have banks like Bank of America, TD Bank. They're also lenders, but they're also financial institutions. So the difference is they don't just do mortgages; they do, and we don't just do mortgages. We do checking, we do savings, we do CDs. We do personal loans, we do car loans, so we do several different financing avenues for you as a bank. So we're not just focusing on your mortgage. We do have a department dedicated to mortgages, but we have a department also dedicated to loans, credit unions, and that type of thing. So those are called mortgage banking lenders. And then you also have what is called just a mortgage banker. So that basically is a mortgage company that just does nothing but mortgages. So you may have, for example, you may know Quicken Loans. Quicken Loans is just a mortgage lender. You may know Mr. Cooper Mortgage. So they just do mortgages. They don't do anything else except mortgages. And then you have maybe the third person, and probably a harder one to work with, is a broker, because a broker actually has the ability to go and work with credit unions, banks, mortgage lenders, and they can actually be signed up with any one of those and up to maybe a few lenders. And actually what they would do is shop around and get you the best deal. But now, when I say best deal, they may be able to shop around and get you the best rate and that type of thing, but they're going to always have to charge you some type of points and fees, because that's the way they're compensated. They're independent brokers, so the way they get paid is by charging you a point of fee. And I'll go over that, what a point is, when we go into fees. But that's the way a broker will actually work. But they have the ability to go to banks and to mortgage lenders and try to find the best deal for you. So it may not necessarily be like they may be shopping for rate, but it may not necessarily be the best deal for you as far as fees go. Okay, so that's the lenders. And then now when you for legal purposes, you always need someone that can close the loan for you. Every lender needs somewhere to wire the money to when it's time to close. So you have what is called an attorney that you will hire. The sellers will also hire an attorney. In some places, in some parts of Jersey, South Jersey, you can hire a title agency, and they will have a settlement agent who can do the closing for you as well. And what basically they will do is there's a lot of legal paperwork that's involved when you're purchasing a house. So you want someone who can actually read through the legal paperwork as fast as possible and be able to still get you an answer. So that's why you want to hire an attorney. Actually, too, if you need to negotiate prices or negotiate credits and things like that, and an attorney can step up and do that for you after you've already signed the contract. And then, like I said, when it's time to wire funds, we need to legally wire into an attorney or an agent's account. We can't just wire it directly to the seller or wire to your account. So you need some legal representation when you're purchasing a house. The biggest thing I always say for first-time home buyers is getting a home inspector, home inspection, and then you want to hire a home inspector to do that. And what a home inspection basically is when you go out and start shopping and you see homes and you say, "Oh, this house is very beautiful. I think I want to purchase. I want to purchase this house," and you love it. You love everything about it. It's exactly what you're looking for. Now, when that home inspector goes through it, he or she is not looking at that house like you would. They're looking at the house and looking for any potential problems that can cost you money down the road. So, for example, they're looking at the age of the roof. They're looking at the electrical system, the heating system, the air conditioner. Does the hot water work? They're looking at the outside. Is there any termites? Is the ground sloping towards the house? When it rains, will water rush towards the house? They're looking in the basement. Is there any potential flooding at this house? So all of those things, home inspectors looking for to make sure that this house is not going to be a money cruncher for you once you close on it. So what they will do is issue you a home inspection, and they'll tell you all the potential problems that you may have, and then you will take that home inspection and you would give it to your attorney and your realtor, so that way you can negotiate anything that needs to be fixed or repaired before you close on it. And so the reason I say it's the most important for first-time home buyers because I have seen deals not closed because of the things that a home inspector has actually covered when they did a home inspection. So that's why it's very important as a first-time home buyer. It's not required for the credit union, but are not required for banks normally, but it is definitely recommended for all banks because they want to make sure, and you want to make sure that you're purchasing something that's not going to cost you a lot of money down the line. Now, home appraiser, a lot of people get these confused, the home inspector, the home appraiser. The home appraiser is the person that the lender, which is just the credit union, any bank or any lender that you may choose, will send that person out. They usually have a partnership with the bank, and the reason we have partnerships is not that we want them to bring the price in at a certain amount. The partnership is that we need someone that we can trust, someone that's going to give an actual real value and not an inflated value, so that you have someone that you've been working with for a while that goes out to do these appraisals. And so what an appraisal basically does is if the seller's selling you the house, let's say they're selling it for $200,000, the appraiser will go out and see if the house is actually worth $200,000. The value comes in lower, we will address that with you, your attorney, your seller, to see if we can get the price reduced. If the value comes out higher, then you're actually purchasing the house with equity. So that's what the appraisal actually does, gives us the true value of the property that you're looking to buy. And just in case we have anyone who's interested in doing, let's say, condo. So when you do that, just remember there's a thing called condo homeowners association fees that's involved. There's a homeowners association. What they do is basically the association, you pay into it every month, so they take care of all the landscaping, garbage, maintenance around the property. There's an umbrella insurance policy that's placed on the actual condo or townhouse or PUD, which is a planned unit development. So the association fee covers all of that. If there's a swimming pool, if there's a health club, all of that is built into the association fee. So just be prepared for that. the homeowners association if you decide you wanted to go the route of a condo. Now, let's get going. So those are all the people that you will be working with. And now what you need to do first is when you start your shopping is you want to get what is called pre-qualified. And what is getting pre-qualified? This lets you know, and it lets your realtor know, and it also lets the lender know how much can you go out there and how much can you afford. And so what basically we will do is put you through we would actually run a copy of your credit report, and we ask you some verbal information. We ask, for example, how long have you been on your job? We're looking for 2 years of employment. We ask you your income. And so at this time, most of the pre-qualification questions are all verbal. We're just trying to make sure we can get the information that we need in order to get you qualified. So you do want to be as honest as possible, because here's the way it works. Once we get you qualified, we will issue you what is called a pre-qualification letter. And so this pre-qualification letter kind of lets you know how much can I go out there and shop for. This stops you from going out there looking at a $500,000 property and saying, I really like this house. And then you find out the mortgage payment on it, and you're like, I really don't like this payment. So getting pre-qualified up front lets you know this is where I need to start at as far as the amount of mortgage I should be looking for, and the amount and the mortgage payment that I want to start as a first-time home buyer. And so the reason I say you want to be as honest as possible, because we're going to ask you questions like your annual income. And then some people like to give the annual income with their overtime in it, and their overtime we may not be able to use. We're going to ask you how much is in the bank. If you don't have money in the bank, you want to be honest and say, I don't have it in the bank. This is what I plan to save. So anything that you're doing during this stage, you want to be as honest as possible. And then at the end of it, we issue you what is called a pre-qualification letter. And that letter is what you want to use. You'll give that letter to your real estate agent to help you start shopping for a house. And I'll walk you through exactly how that works later on when we get towards the end of this. Now, some people go a step further. Instead of getting just pre-qual, they like to get pre-approved. And what the difference is a lot of the pre-qual information we got from you verbal. Pre-approved is different. You will actually supply us with all the information that we need to see. Your pay stubs, we want to see 1 month of pay stubs, 2 years of W-2s, 2 years of tax returns, 2 months of bank statements. If you have if you want to use your 401k, all that information you would email that to us, or you would fax it to us. And you would scan it over to us, and then we would actually take that information and submit it over to an underwriter, and an underwriter will actually review your file and have you what is called pre-approved, which means it's a lot stronger because everything has been seen at that point. The only thing you need to do at that point is actually find a property, get us back a contract, and we can order an appraisal, and we can close you a lot faster because we've already actually approved you as a borrower. You have already been through the underwriting stage of it. So that's the pre-approval start. So remember, pre-qualification is basically a lot of information is verbal. You can still shop for a home with a pre-qualification letter, but a pre-approval letter is a lot stronger because you have supplied all information that a lender would like to see in order to get you qualified. Now, what do we do in order to get you pre-qualified? So remember, we ask you questions, we take information from you, we do run a copy of your credit report, and then what we do is with that information we start putting together to try to figure out how much of a home you can afford. And so basically what we're looking for is your principal, interest, taxes, and insurance. That's called pitting. And so basically we take the mortgage payment, we take your sales price, and then we try to figure out how much you're planning to put down. In this case, we're going to use 5% down. That's $10,000 down. That gives you a loan amount of $190. That would be your loan amount. Now, this slide was done back when the rates were a little bit lower. They're a little bit higher than 4% right now, but we'll just use the slide that we have here. So 4% is the interest rate that we're using. Now, the house that you like is the property tax is about $5,000 a year, and homeowners insurance is $700 a year. And so those two numbers we take and we divide them by 12. When we break those into your mortgage payment, that's going to be called your escrow. And I'll explain to you how that works also. So principal and interest is actually your mortgage payment. So 190,000, we run it through the system at 4%. It gives us principal and interest, which is $907.09. That's actually the mortgage payment. The principal part pays down the balance of the loan, which is the $190,000. The interest is where all lenders make their money at. So you make the interest payments back to us, and they accumulate over if it's a 30-year mortgage. So that's what we actually make money back for doing the loan with the interest. The taxes, $5,000 is broken down by 12, $416.67 a month is your property taxes. Your homeowner's insurance is $58.33 a month. That's the $700 insurance that you provided. And then If you put down less than 20%, there's a thing called PMI, which is private mortgage insurance, right? PMI does not cover you like homeowners insurance would. It covers the lender in case you decide to walk away from the property. Anything less than 20%, they consider a risk. So they add what is called private mortgage insurance on there. Once you actually pay your house down and get it to, it's really get it to 78% loan to value. But if you get it to 80%, you can ask for an appraisal and they can take the PMI off. Once you get to 78%, it has to come off automatically. The PMI does. And so the PMI can go away. But if you put down anything less than 20%, there will be PMI on there. So in this case, we have your principal and interest, your taxes, your homeowner's insurance, your PMI. And so the total mortgage payment is $1,502.09. And what we need to do is try to figure out this mortgage payment into your income. So the next thing we do as a lender is we look at you, we asked you what your income was, and you told us it was $50,000 a year. We divide that by 12, that gives us $4,166.67 a month. And then we've also ran your credit report, and the debt that we had on your credit report was $400 a month, car payment, credit cards, student loans. Those are the things that we usually run across on the credit report, personal loans. In this case, $400 a month is what we have. And so what we need to figure out is called your ratios. Now, just to let you know, when I was telling you about lenders, we all go to a place called, we all use the same investors, whatever lender you decide you wanted to work with. So if you decide it's going to be the credit union, if you decide Bank of America, TD Bank, Mr. Cooper's Mortgage, Quicken Loans, or even that broker, we all use the same investors when we're doing a mortgage. And the investors are named Fannie Mae, which is Federal National Mortgage Association. You have Freddie Mac, which is Federal Home Loan Mortgage Corporation. And you have FHA, which is the Federal Housing Administration. And then if you're a veteran, we would have the VA. So those are called mortgage investors. And the reason we all use that is because we may sell a loan or we may not sell it, but we do have to close it under some type of federal guidelines. And so the guidelines are set by those investors, Fannie Mae, Freddie Mac, FHA, VA. And so whatever they say in the guidelines is what we have to follow as a lender. So if we go to our guideline books, the guidelines say that more no conventional loan, we want the front ratio to be no higher than 29, the back ratio to be no higher than 45. FHA may be a little bit different. FHA may be 31 and no higher than 46. And VA, I think, is at a 49. It gives you only one ratio. But we have to make sure we follow those guidelines, even if we're going to hold on to the mortgage until you for 30 years. But at some point, a lender may want to sell that mortgage to the investor. And then if they didn't close it under their guidelines, they cannot sell it. So that's why we follow. That's why every lender that I just mentioned, no matter where you may go, if it's a actual lending institution, they follow these guidelines. So in this case, the guidelines is telling us that we need to be at a 29 front and 45 back. So what is that? So that means that your mortgage payment divided into your income, $4,166.67, is 36%. So that means that mortgage payment is taking up 36% of your income. So remember, your income that we're using it is gross. So we're not taking, we have to take into account that you still have to pay taxes, insurance, anything else that's taken out of your mortgage payment. We know that you're not walking in the door every month with that 4,166 in your hand. So we have to take into account and have some room for you to still live and still enjoy life when you actually purchase a house. So that mortgage payment is taking up 36% of your income. So it's a little bit higher than what the guideline says, but we're really focusing when we're dealing with the investors is the back ratio. Can you carry the mortgage payment plus your debt and still be able to have that ratio low enough to have that where you still have some income coming in every month? So if we take that mortgage payment of $1,502.09 plus the monthly debt of $400 and put it together, that's $1,902.09, and we divide that into your income of $4,166.67, and that gives us a 46 back ratio. And now what you're saying, oh, that's higher than that 45 that we have on there. Yeah, it's higher, but it's only like 1%, so it's right there. Sometimes we have a little room to go, 46, 47, a little bit higher. We are not going anything over 49 or 50 because that means that the mortgage payment is taking up 50% of your income before taxes are even taken out. And that means when you actually make your mortgage payment, you don't have enough money to actually live on. So that this is why we actually look at these ratios and try to make as much sense as possible to when lending, because we still want to make sure you can afford to make your mortgage payment, but also still afford to live. You shouldn't be having to stress every month to make a mortgage payment along with your income. So those are the ratios that we have in this scenario: 36-46. So yes, we can still make this loan. So we can issue your pre-qualification letter at this point. Then what we do is also, as a lender, we go over what fees are. And so fees, one thing is your down payment is when you purchase a house. The other thing is your closing costs. So there's two big chunks of things that it all goes together when you purchase the house, but it's two big chunks of money, different avenues of money that you're looking at. So the down payment, remember, was $10,000. Then you have your closing costs, which can run up anywhere from 6,000, sometimes 10,000. They can be very high depending on your taxes and depending on the fees that you pay. Now, lender fees is one of the big things you want to focus on as a first-time home buyer. Now, a lot of times when a person decides they want to look for a house, and they call us as mortgage lenders, and the first thing they want to know is, okay, what's your interest rate? And that interest rate is very important because that's going to set your mortgage payment, but it's not the most important thing when you're actually shopping for your mortgage. A lot of things you want to figure out is what is your lender fees, because the lender fees can actually be very high depending on who you're actually dealing with. Now, the credit union across the board, I think our fees are $875. And when I say fees, I'm talking like the appraisal fee, the credit report fee. We have an attorney review fee. We have a flood cert fee. We have a credit report fee. So those fees, when you put all those fees together, they come up to about $875. Now, some places you may go, you may pay what is called an application fee, which can range anywhere from $475 to about $900. You can pay an underwriting fee. You can pay a doc prep fee. You can pay. There's a bunch of fees that we call junk fees that they will add on, and so sometimes the fees can go from $5,000 to $9,000 depending on what they're charging you. If you have points in there, well, the point is 1% of your loan amount. If we take the loan amount that we had, 190, 1 point is $1,900. So those are called fees. And so when you're shopping for your mortgage, don't let the interest rate be the only thing that you say, oh, that's what I want to check on. You want to also know what are your lender fees, and the lender can give you what is called an estimate, so that way you can know what the fees are. And then you have other fees that we're going to give you that you can shop for. And the home inspection fee is not one of the things that's going to be on what is called the loan estimate that we'll give you. But it is a fee that you want to be aware of. Remember, I told you how important that home inspection is. So a home inspection is probably about anywhere from $700 to almost $900 to have an inspector go out and check the property. But it is definitely well worth it, because you can actually, I've seen some people that did the home inspection, had an in-ground oil tank, and next thing you know, it's not working anymore, but it's leaked. You have to have it pulled out. That can cost you anywhere $30,000 to $40,000. And if you don't do a home inspection, you won't know that until you actually close on it, but then it could be a potential problem for you down the road. So that's why the home inspection is so important. Next, you have what is called your prepaid interest. Now, this interest changes depending on when you close. So a lot of times, if you have any friends or any relatives who actually purchased a home and you ask them when did they close, a lot of times they'll tell you towards the end of the month. And the reason they do that is because the interest, we as a lender will charge you what is called prepaid interest. So if you close on the 1st and it's 30 days in that month, we're going to charge you interest from the 1st to the 30th, which can sometimes end up like $500, $600, maybe $700. So sometimes if you close on the 29th of the month, and it's 30 days in the month, you may pay 29, 32 days of interest, which is a lot less. And then it drops your closing costs down a little bit more. So prepaid interest, you want to watch when you're closing, when you actually set up a contract. More than likely, your realtor will set up a contract for your close towards the end of the month. Title work. This is probably one of the biggest fees you're going to see on there. This is something you can shop for, but a lot of times your attorney or your title company will actually get this, get the title work for you. What is title work? Title work is actually what shows when you purchase a house, any type of liens, any type of judgments, any type of things that may be attached to the house that you don't know about. You will not know until a title company runs what is called back title on it, and they will go back all the way from that when that house was actually built, to make sure that every owner that owned that house doesn't have any type of liens, any type of judgments attached to that house. So when you close on it, you got what is called clear title. And the only person that can do that is a title company. And so they can charge you, and they will charge anywhere from $1,500 to sometimes almost about $2,800 for title work. Like I said, your attorney will sometimes order this title work. If you use a title company to close you, they will order their own title work, but it's probably one of the biggest fees you'll pay. You can shop around for it, but it is across the board. You're going to probably run across the same price for title work. Now, escrows. So what is escrow? So escrow, remember I was telling you about that principal, interest, taxes, and insurance? The taxes and insurance part is called your escrow. And what that is basically we as a lender will pay your taxes and your insurance every time you make that mortgage payment. And the reason we do that is because those pieces of that mortgage payment is so important that we need to make sure it's paid on time. Why? Because the taxes is your property taxes. So everything in whatever town you decide to buy in, they're going to charge you property taxes, right? And those taxes run your township or run your town or your area. So your town is based off the homeowners in that town paying taxes on time to make sure the police department, fire department, the school system, the sanitation department, all of those departments are based off of the homeowners in that town paying their taxes on time. And so the way that we can ensure the taxes are paid on time is that we can collect it when we may collect your mortgage payment, and then we put it into an account. And so every quarter we pay your township in New Jersey, January, February, March, we paid first quarter taxes. April, May, and June, we pay the second quarter taxes. So every time you make a mortgage payment, we put it into an escrow account and pay those taxes. And believe it or not, a township will come after your house faster than the lender would, because if you're not paying your taxes on time, they will come after your house. And so that's why lenders like to make sure taxes are paid on time, because your township really can't run without it. And the next thing you have in that escrow account is your homeowner's insurance. This is another thing, reason the lender wants that paid on time is because that insures the property. If you don't have homeowners insurance, and God forbid, a tree fell on the house or something happened to the house and you can't make the payment anymore and the house is not there, the lender has lost the actual investment that they have. So the lender wants to make sure you have homeowners insurance. In order to do that, they make sure they put it in your mortgage payment. So you actually will go out and get a homeowners policy. Let's say you go to New Jersey manufacturers and they say $700 is your homeowner's policy. You will give them a check for $700 for the first year. And you say, well, if I give them a check, then why do I need to pay you every month when I make my mortgage payment? And the reason we do that is because you pay for the first year. So let's say you're going to close in June of 2023. And so you're going to pay from June 2023 to June 2024 upfront. And then when you start making your mortgage payment, and that's probably not going to start until August if you close in June, we're going to collect a insurance payment from you and put that in escrow. So when next year, when June 2024 rolls around, we write the check directly to New Jersey manufacturers from your escrow account. You no longer need to make a payment from there. We make it from that point on out of your escrow account. So that's how the escrow account is set up with the principal, interest, taxes, and insurance. Next thing is your attorney. You actually pick your attorney. You actually shop around for it. So you can pay him or her, and you don't pay them until we get to closing, but the attorney's fee is probably anywhere about $700 to $1,000 at this point. Some attorneys could be $1,200, but you don't want to get an attorney. I have seen people get an attorneys for $300, $400 a month. And believe me, it becomes a nightmare because that attorney usually gave you a very good deal, but they're really doing other things like in court all the time and not available for you. And you want an attorney that's available for you because this is a big transaction for you. So don't try to cut corners and try to get the most affordable attorney. You want to get a good attorney that's going to be there to advise you throughout this transaction. Next thing you have is the survey. And what is the survey? So the survey is a bird's eye view of your property. It gives you the land, it gives you your actual house, the frame of your house, the measurements of the house, also the measurements of the land that you're buying. So you can know if you're purchasing a house without a fence up, you know exactly where your property starts and stops at. So that's what the survey will actually give you. If you close on a house and you actually look at your survey, you can actually see if your neighbor's fence is on your property. You're not going to ask your neighbor to remove it, but you know this is my property. And so that survey actually tells you that. Survey runs anywhere from I would say probably about $700 to $900 for a survey, but you definitely want one. I think we require a survey for every closing, and most lenders do. So they want to see a survey. Your attorney or your title company will order the survey for you. Recording fees. This is basically charged by your county or your township when they record your mortgage to say you own the property at 1 Main Street, and Mr. and Mrs. Johnson, you own this property at 1 Main Street, and they record it. And the recording fees can run anywhere from almost about $250 to $400 for recording. So when you put all these fees together from us at the credit union, we're looking at about $4,500 to $6,000. So you got the down payment, which is $10,000, plus the closing costs, which is about $6,000, so about $16,000 to purchase this home. Once we got that, we go into mortgage programs for you. Most people want a 30-year mortgage. What is a 30-year mortgage? Means that the rate stays the same for 30 years. It's fixed. for 30 years. You can also pick a 20-year mortgage, which is it's fixed for 20 years. You pay the house off 10 years faster. 15 years, you pay the house off 15 years faster, and then there's a 10-year available as well. So those are called fixed rate mortgages right now. Because the rates are so high, some people are opting out to do what is called an adjustable. So you have 3-1, a 5-1, a 7-1, and a 10-1. And so basically they work like this. The first number is called your fixed rate portion. So let's take the 7-1. So 7-1, for the first 7 years, your rate is fixed for 7 years. After that 7th year, the 8th year becomes an adjustable. And so the way it actually works is I'll just give you some estimated numbers. So let's say, for example, you took a 7-year ARM and a rate at 4%, right? So that 4% has a capital in there. It's 2 up or 2 down. So that means that if once you get to that 8th year, that rate can go from 4% to 6%, or from 4% to 2%. But it can drop down. And believe it or not, in the past, when the rates were lower, if you had an adjustable, the rates did drop down because the rates were lower. So it all depends on where the market is at when you get to that 8th year. Some people take an adjustable just when the rates are, let's say, like they are now 6.5%, 7% in that range. You can get an adjustable for a lot lower rate, and then you can turn around at the 4 or 5 years. With the credit union, we have a modification program where you don't actually have to refinance, but if you wanted to refinance, you have that option as well. So refinancing is actually changing the terms of your actual mortgage from a 7-year, you want to refinance them through a 30-year. The modification is a little bit different because you have to stay with the type of program you have. You can just change with whatever the interest rates are available at the time. And so just in case you have any big spenders on the call, we do have what's called jumbo mortgages or high balance mortgages at the credit union. All lenders pretty much have these. Anything over a certain amount, 500,000 is considered high balance. Anything over $1 million is considered a jumbo loan. So you want to ask your lender about if you're looking into that type of property. Check with your lender first, because the rates and the closing fees and everything are a little bit higher because of the type of financing that you're doing. Okay. Now you got down payment, choosing your mortgage. How much do I want to put down? Remember, credit history is important. We do have to run a credit report. We look for 620 if minimum credit score, but believe it or not, you want to try to have it at least at 660, 670, because if you're at a 620, it's going to probably give us a hard time with the pre-qualification stage, which means we have to send it to an underwriter to be manual underwritten. Most lenders operate the same way. So the investor would like to see something a little bit higher so you can have it approved right away. If you have credit problems, you want to check with us and lender. We do have partners that we work with that can help you and assist you with credit cleanup and that type of thing. Financial goals, property goals, they're usually the same, which means that, hey, how long do I plan to live in this house? Is this my first house? If I'm going to buy a second house after this, you can buy a house as your primary residence. And then a couple of years later, you can say, I'm gonna make this an investment property and buy another house as your primary residence. You can buy a house and say, I'm gonna buy this house for 5 years. I'm gonna sell it and buy me another house. So all of those things you want to write down. You want to have your financial and your property goals in mind when you're looking to purchase your house. We went over the loan terms, if you did a 30-year fix, if it is an adjustable, and we covered your closing costs. And just remember, credit scores can range anywhere from 300 to 800. Credit union and most lenders look for a 620 or higher. If you need an FHA mortgage, which is usually not a conventional type mortgage, FHA can do about a 590. We don't have the FHA right now at the credit union, but if you have any questions on an FHA mortgage, I'll be more than happy to answer them. I just went over some of the programs that we do have at the credit union. Remember, when you're actually starting to do this, if you decide, okay, I want to buy a house, make sure you check your credit and you want to try to have your credit as in line as possible when you get ready to buy, because buying a house, I'm just going to be honest with you as a loan officer, it's very detailed and it almost feels like a long and hard process. And so if you're not only battling trying to get qualified, you're battling having negative credit, if you're a slow payer in the past and that type of thing. So you're adding more problems onto you trying to get financed for a mortgage when you're starting off with negative information on your credit report. So you want to try to clean up as much as negative or derogatory information on your credit report as possible before you start the process. All right. Now, down payment, how much do I need? So it used to be you needed to put 20% down in order to purchase a house. Then FHA came along and said you could put 3%, and now they moved it to 3.5%. But then the conventional programs came along, which is Fannie Mae and Freddie Mac, and said, hey, we can do as little as 3% down as well. So as a first-time home buyer with the credit union, you can put as little as 3% down. You can also get gifts. So what is a gift? Is you have a relative who wants to give you down payment assistance or money towards your closing costs or down payment. That's called a gift. That means hopefully you don't have to pay it back. So that's called a gift from a relative. You can do grants. We do work with some company. We work with companies at the credit union who offer grants. Grants are usually down payment assistance anywhere from $5,000 to $10,000. It doesn't have to be paid back as long as you're in the property for 5 years or longer. And the same thing with DPA. DPA is down payment assistance as well. Sometimes you can get more than $10,000 with down payment assistance because they're private institutions that are offering that money. So with our first time homebuyer program, we can do as little as 3% down, but you can also get that money in a gift of grant. That 3% down and your down payment can come in a gift of grant, and your closing costs can also be in a gift of grant or down payment. So so you no longer have to look for just 20% down. We have programs there to assist first-time homebuyers and help them get into that house a lot faster and make it affordable for them. We do want to see you have something left in the bank, but we do want to make sure to make sure that you're comfortable when you own your first home. All right, now real fast, I'll walk you through this whole process, and then we'll go right into getting some questions from you if you have any. So we showed you how to get qualified. We showed you what you need to do. Now we're going to walk you through the entire process. Now you went through the mortgage, you came to the lender, you came to us, the credit union. We got you pre-qualified. We got you approved. We gave you your letter. You went out, you took that letter and you called up a real estate agent. You say, hey, I want to purchase a house. You give the real estate agent that letter. Real estate agent will then go into the computer and look for properties in that price range that you have. Remember, we were at 200,000 sales price. We're doing 190 loan amount. So the realtor's going to look in the properties in that range. You tell your realtor what you're looking for, and just in case, what you want to do is you want to write down in the tablet somewhere exactly what you want as a first-time home buyer. Whether you want a 3-bedroom, 2.5 bath, 4-bedroom, 3-bath, 2-car garage, all the things you want on your wish list. You give that to your real estate agent. They're going to go to the website and start looking for properties in that price range. They're going to come up with a couple of properties to take you out at. Let's say they put 5 together. 5 of them you go look at, 4 of them you didn't really like. That last one you really like. You walk into the house, you say, hey, I really like this one. This is exactly what I'm looking for. And the real estate agent, a very good real estate agent, will say, hey, okay, you like this house, let's put in an offer. And you said, okay. So the real estate agent will pull out a contract. Now that contract is saying that you're going to offer the seller whatever price you and the realtor decide you want to offer them. In our case, we're going to say 200,000. You're going to write up a contract for 200,000. On that contract, you're going to put dates on there. You think you can get a mortgage and that type of thing, and you're going to sign it and send it over to the selling agent, and then the agent is going to say, the selling agent is going to present that to the seller, and the seller is going to say, hey, I like this offer. The seller is going to sign it. Now you have a binding contract between you and the seller. It will go to your attorney and to the seller's attorney, and that's called attorney review period. During that period, your real estate agent will come to you and say, hey, it's almost out of attorney review. Let's go do a home inspection. That's when you're going to call the home inspector, and they're going to go out and do the home inspection right before the attorney review period ends. If there's anything in that home inspection that needs to be fixed or anything credits that need to be done, you're going to give that to your attorney in the home inspection, and they're going to ask the seller to either fix it or give you a credit for it. Once all of that is complete, you're going to have a contract in your hand. The next thing you want to do with that contract is you want to give it over to your lender. The reason I said that is because that contract now has dates on there. You have what is called the date that you sign the contract, the date that they're looking for you to be approved from your lender, the date that they're looking to close you. And so all of those dates that's on there, your lender's going to then take that information and run with it. So as soon as we get the contract, we're running with it and we're setting up those dates. We need to have your commitment in your hand, which is your loan approval. And then we need to follow that up by getting you closed on the date that's on that contract. Now, the processing team at any lender that you work with is going to start asking you, if you didn't give over this information already, your pay stubs, your bank statements, your 401k statements, your W-2s, all of that documentation that we need in order to purchase your house. Now, doing this process and doing the whole time that you're pre-qualified, that is not the time that you want to open up any new credit cards. That is not the time you want to throw any big, large deposits into your bank account. Anything over $1,000, you're going to need to source that. They're going to want to see a paper trail. What is a paper trail? So let's say you took money from your 401k. 401k will give you the money and also send you paperwork to say this is where you took the money from. So if you're a person that has money in your house, in the mattress or somewhere, and you decide you want to put it in the bank, talk to your lender first so they can show you how to structure that payment, because you don't want to put any large deposits into your account. You don't want to, it's not the time you want to quit your job, because now they're going to do employment verifications and all of those things. It's also not the time you want to go and establish any new credit. You don't want to go to Raymond Flanagan. You don't want to go PC Richards to get a new TV. You don't want to do anything at all at this point except provide the documentation that is needed to get you approved. Remember, we qualified you with the information that we saw on your credit report. We wanted to be the same information when it's time to actually get you ready to close. Now, the processing team will also send out an appraisal to make sure the house is worth $200,000. Then once the appraisal comes back, if the house is worth less, remember we address that with your attorney and your title company or your realtor. If the house is more, we don't say a word. You have a house with equity. The appraisal is in, all of your docs are in, it's sent to an underwriter again for approval. The underwriter approves it. Now you have a commitment in your hand. We met the commitment date, and you give that to your realtor and to your attorney. They then call up a title company to get your title work back over to the lender so they can get you in the closing department. And then once you submit it to the closing department will then contact your attorney, and then they start scheduling the fees, anything that you put down payment, anything that you've given as far as appraisal fees and that type of thing. All of that stuff is settled with your with the closing department and your attorney. And then our closing department will send a package to the closing along with a wire for the amount of money that you need, $190,000. You would go to the closing table, and it's not, you can't do anything electronic. You still have to manually sign a lot of paperwork. Your attorney will give you keys to the property. We would suggest you call a locksmith to change the keys, because it's now your new property. And now you can take all your furniture, pack it up, move it into your new house. And then at that point, you've closed, so you can go get your TV and your washing machine and stuff from PC Richards, and then you can go to Raymond Flanagan and get your furniture at that point, because you have moved into your new house. And that is a quick way of how it all works. And like I said, at the Credit Union of Jersey, you can contact us anytime. I'm a loan officer. We have other loan officers. We have Kelly Everton, who works there. We have, she has an assistant, but we have Chris, who also assists us. So we have a team of people there that's willing to help as soon as you're ready to purchase your first house with any questions you may have. I will turn this back over to Andrew if we have any questions.
All right, thanks so much, James. If anybody does have questions, please feel free to submit them in the chat or the Q&A, and we'll be happy to address them. Buying a newly built home, will closing costs be less because you won't need an inspection, etc.?
Yeah, so the closing costs will be just a little bit less. I mean, you don't have to do, because everything is brand new in there. You can skip the home inspection part of it if you want, but you're still going to have a title work, and you're still going to have the other closing fees that's involved. So maybe anywhere from $800 to $1,000 less, but the other fees will still be there.
Do they also include condo fees and CDD fees in escrow?
No, so condo fees. So basically, when you have, let's say, the association fees and all that stuff, that's paid directly to the condo. So you will be dealing with the association for condo fees and anything like that. So that won't be built into your escrow account.
The process you've just outlined, is it the same for condos and houses?
Yeah, so the process I just outlined is the same for condos, houses, or plan unit developments. It's a little bit more detailed than that. That just gave you like the quick picture of it, but it's the same process. No matter if you're buying a house or a condo or a plan unit development, which is a townhouse.
What kind of grants are available?
It depends. We work with different agencies for grants. For example, there's county grants that we look for. Let's say Burlington County, Mercer County, and then there's a partnership that we work with a company called New Jersey Community Capital, which have grants anywhere from $5,000 to $10,000. And then they have a Trenton funding grant, which is if you're buying in the township of Trenton, a city of Trenton, there's a $10,000, $20,000 grant, but it has to be in Trenton. So we try to figure out where you're looking to buy at, and then we try to see if we can have, if there's grants available in that town. The majority of the grants are usually 5-year forgiving, which means if you're in property for 5 years, you don't have to pay anything back on them, and they go away after 5 years.
What is the recommended down payment amount?
It depends on what your budget is. Like I said, we do have that for first-time home buyers. You can go as low as 3% down. A lot of people, depending on what they're trying to get their mortgage payment to, the more you can put down, the more affordable your mortgage payment is. So if you put 5% down, 10% down. So it all depends on what that person's budget is and what they can afford to put down, because it's not just the down payment closing costs. We also want to make sure that once you put everything down, you still have money left in the bank to make it comfortable for you when you purchase your first home.
Some programs provide down payment assistance. Is this assistance based on your income?
Yeah, so some programs do it with grants and stuff. A lot of them are dependent on if you're going for a county in Mercer County, Burlington County, they're all driven off of income. The partnership that we have with New Jersey Community Capital is the income level can be a lot higher. So when I say Mercer County, you're probably talking about $50,000 as far as your income. With New Jersey Community Capital, you could probably be making anywhere from 80 to 90,000 as a first-time home buyer. So it all depends on what your income is, because if you're making $150,000, then they look at it and say, hey, this person should need a grant at that point. So that's the way they look at it, the grants.
Is there a way a potential buyer can figure out what the PMI would be before signing a contract?
Yeah, so your lender can actually figure that out for you. Most lenders when you decide you want to go for a house and you see something you really like, a lender can run it through a PMI system, depending on what the sales price, your down payment, your credit score. Because PMI is based off of how much you're putting down and what your credit score is. So if you have a really good credit score, your PMI payment is going to come out really low. If your credit score is like a 630, 640, then PMI could be a little bit higher. But when I say a little bit higher, I'm going to say, let's say, for example, on the house we were using 190. PMI for a person with like a 780 credit score may come out to about $80 a month. A person with 620, 630 credit scores, that payment may be like 110 a month. So that's the difference in the payment.
Can you apply for a mortgage for an overseas property?
No, you cannot. No, you can't. Not with us. We can do mortgages at the credit union and throughout the United States, but not anything overseas. You can. There are lenders though that you talk to, but it's going to be mostly financial banks that operate overseas that you can probably speak with.
While looking on Zillow, how realistic are the estimated payment and monthly costs?
They try to be as close as possible. They're not exact because your interest rates and everything change every day. So they're trying to just give you like a ballpark on Zillow. You want to talk to a lender directly. And like I said, she's still, even that, because nothing is locked in, we can walk in to the credit union today and the rate is here. And then tomorrow the rate can be lower or the rate could be higher. So most of it's estimate, but it's a pretty close estimate to try to keep you in line with what you're looking to do as far as goals and budgets and stuff.
I heard that putting down less at closing, let's say 5%, then 60 days later to put down the 20% is a better option. Any thoughts?
No, because you actually if whatever you're putting down at closing is going to set your mortgage payment. If you have money after closing and you want to put it towards your principal, that's going to lower the amount of interest that the credit unions or the mortgage company is going to collect from you, and it's actually going to lower your term. It's going to close maybe your house off faster. So if you took a 30-year and you put a big chunk of money into your principal, you're going to be paying off the house faster, but your mortgage payment that you set at closing is going to be the same unless unless you talk to your lender and say, can I do a modification if I put this amount of money down? So if you decide you're going to put down a certain amount before you get to closing, and then a couple of months later you want to put a big chunk towards it, it's going to only go towards your principal. It's not going to actually change your mortgage payment.
How do you know which lender or bank to use? Will some give better rates than others?
Yeah, so it's like I was telling you before, one of the things you want to check is it's not necessarily just shopping for the rate. You want to shop for fees as well. So every lender we like I said before, we all follow Fannie Mae, Freddie Mac, FHA, and VA. They set the actual tone on their interest rate. So they tell us this is the rate that we're buying. And so when the market is set, these are the interest rates that we're using. So no matter which lender you're talking to, we're probably going to all be in the same ballpark as far as where the rates go. It's where the fees are is what you're looking at. If a lender's going to charge you application fee, points and that type of thing. So when you're talking to a lender, it's not just the rate you're interested in, it's also, okay, what is your lender fees is what you want to find out.
All right, we can wait a few minutes to see if there are any other questions that um, that come in. Any other information you want to share, or reminders, or some closing thoughts?
Yeah, just like I said before, like it is a really good time to buy, and a lot of it's starting to pick up right now, but it is still on the more of the buyer side as far as shopping right now than it was in the previous, because the rates are higher, so it's a less pool of buyers out there, which means you can walk into properties now that you really like and negotiate more than you could in the past. Before, when the rates were low, you had so many buyers out there that it was like you had to, when you made an offer on the property, you was doing highest and best. So you were actually negotiating and then probably taking the price up higher than what the seller was looking for, because there's so many buyers. So right now, we think it's, even though the rates are high, it's still a good time to buy because you can negotiate better or getting a better price on a house.
Alrighty, well, I don't see any more questions, so I think we can end it there. Thank you so much, James, for
Oh, you're
presenting on
welcome.
this. It can be very confusing, but you did a fantastic job, and we appreciate
Absolutely.
you speaking.
Absolutely. Thank you, Andrew, for inviting us again at the credit union.
Absolutely. Um, and just a reminder, this week is Money Smart Week, so thank you again for kicking off Money Smart Week programming at the library. Tomorrow we will have healthcare and your retirement. And then next week, to kind of wrap up Money Week, we're going to have another program on oh my goodness. Strategies for sustainable income in retirement. So please look out for those. If you haven't registered, you can do it on our website. And again, thank you so much, James, and the Credit Union of New Jersey for being our continued partners.
Absolutely. Thank you so much.
All right. Have a great day, everyone, and hopefully we'll see you later.
All right, you too. Thank you.